All right, we are now broadcasting. I'm going to wait 1 minute just so that people have a chance to get on the call, so we don't begin before the technology catches people up with us. But just 1 minute, and thank those of you who are early arrivers on the phone. Do a first thank you for joining us, and then wait 1 more minute to officially open up. Just one. All right, not to keep people waiting. Well, good afternoon. I'm Lisa Donner. I'm the Executive Director of Americans for Financial Reform, and I want to thank everybody enormously for joining us for this, which is the third in our series of programs marking the 10th anniversary of the Dodd-Frank Wall Street Reform and Consumer Protection Act, and thinking together about what changes to the financial system are needed now to tackle inequality and advance economic and racial justice. We are incredibly honored that House Financial Services Committee Chairwoman Maxine Waters is our keynote speaker today, and our community and the whole country really are incredibly fortunate to have her committed and skillful leadership in that position. After Chair Waters' remarks, I'll have a conversation with FTC Commissioner Rohit Chopra on his perspective on some key problems in the financial system and ways to address them. And then beginning at 3, we'll have an excellent panel, including Rich Dubois, Executive Director of the National Consumer Law Center, Christina Livingston, Executive Director of the Alliance of Californians for Community Empowerment, Greg Jefferson from the AFL-CIO, and George Washington Law School Professor Art Wilmarth, moderated by AFR's Legislative and Advocacy Director, Rion. Please stay with us for those conversations as well. But first, I'm going to hand the virtual mic over to Hilary Shelton, the Director to the NAACP's Washington Bureau and Senior Vice President for Advocacy and Policy there. And also, I should add, a member of the AFR Education Fund's Board of Directors, to our great honor, to give Chairwoman Waters a proper introduction. Hilary?
No, thank you very much, Lisa. And it's great to be here with you and all those who are listening in. When we were negotiating what was to become the Dodd-Frank Wall Street Reform and Consumer Protection Act, we were in the midst of a recession that was disproportionately hurting communities of color, most specifically African Americans. According to the report released by the April of 2000 by the Department of Housing and Urban Development, or HUD, subprime loans, which were a major cause of the recession, and many of the foreclosures were 5 times more likely in Black neighborhoods than in white neighborhoods. One result of this uneven distribution of subprime loan was that African-American households were nearly 50% more likely to face foreclosure than their white counterparts. In 1 year, 2008, more than 850,000 American families lost their home foreclosures, and were more than 3.1 million foreclosures filings, which means that 1 in every 54 households received a notice. Between 2006 and 2014, nearly 10 million homeowners in America saw the foreclosure sale of their own homes. While white Americans represented the majority of foreclosures, families of color were disproportionately affected. Although we were less than 14% of the overall population, African Americans represented almost 22% of those whose homes were subject to foreclosure. At that time, one of the rallying points of the NAACP was economic justice, and the prohibiting of targeted, unsustainable, predatory loans is a major civil rights issue. It was then, and it still is now. As a result of, with their empathetic, solid leaders like Barney Frank and Chris Dodd, who could count on people, including today's keynote speaker, to have their back and hold their feet to the fire, we got the effective law that we did. The Dodd-Frank bill, as it quickly became known, resolved a lot of problems facing all Americans. Dodd-Frank banned subprime loans. It prohibited many forms of unsustainable predatory lending, such as exploding arms and balloon payments, as well as practices which contributed to the foreclosure crisis in the early 2000s, such as yield spread premiums. Dodd-Frank also created the Consumer Financial Protection Bureau, or CFPB. The CFPB remains the only agency within the federal government that was established to protect and educate consumers first. In the first 5 years of its existence, the CFPB was on the right track in terms of informing, educating the American people, and protecting consumers. Sadly, under the current administration and its present day lackluster leadership, the CFPB is being steered off course, far removed from its intended goals and directions. As such, it neither adequately informs or educates the public, nor does it do a good job of protecting the American consumer. The reinvigoration of the CFPB, its restoration, one might say, to its intended glory through Consumers First Act is just one of the ways which our current keynote speaker is using her considerable natural talents to the betterment of all Americans. She is also, through the Consumer First Act, staying true to the dream of Frank and those who have gone before her. She is using her position as chair of the House Financial Services Committee to help all Americans, as Chairman Frank may have wanted her to do, and to counter those who are just looking for ways to make the rich richer and to disseminate against whole groups of people. She has been extremely proactive in her efforts to help those who may be most hurt by the current pandemic by offering housing assistance and housing vouchers for families who may be evicted or foreclosed upon. She has also introduced a bill to aid individuals, businesses, and state and local government for the duration of the emergency period. Our current speaker has always gone out of her way to demonstrate not only the courage of her convictions, but her sheer intelligence as well. Not only is she committed to ensuring that everyone has a seat at the table by creating a subcommittee on diversity and inclusion, but she has also shown her sharp acumen for the needs of Americans by establishing task forces on artificial intelligence and financial technology. Ladies and gentlemen, there is no way Senator Dodd, Congressman Frank, or any others authors of this important law could have predicted the plight in which we find ourselves today. Our nation and the global economy have been disseminated by a pandemic of epic proportions. We do not have effective, coordinated, consistent federal leadership at a time when we really need it. What we do have, however, is a light to help us out of a tunnel in which as many of us have been down before. The light is, of course, the tenets behind the Dodd-Frank Wall Street Reform and Consumer Protection Act and the wise protections the law continues to offer. And holding that light, showing us the way, and protecting those who need our assistance is our keynote speaker. Ladies and gentlemen, help me recognize and bring to the podium now California's 43rd Congressional District and current Chairwoman of the House Committee on Financial Services, Congresswoman Maxine Waters.
Wow, good afternoon, everyone. And thank you, Hilary, for that generous introduction. I'm very pleased to join you for this event, focused on looking forward 10 years after the passage of Dodd-Frank Wall Street Reform and Consumer Protection. I want to thank Lisa Donner, Executive Director for Americans Financial Reform, for inviting me to this event. And thank you again, Hilary Shelton, Director to the NAACP's Washington Bureau and Senior Vice President for Advocacy and Policy, for that generous introduction. But I really want to thank both of you for your tireless work these past 10 years in the fight for financial reform and financial inclusion. And I want to thank you for the way that you have worked with my staff. My staff has benefited from your knowledge, your involvement, your interest, and because of your willingness to work so closely with us, we've been able to point out what is happening, with our CFPB, for example, and the way that they've tried to dismantle it, and all of the other issues that we deal with the Dodd-Frank reform that we've tried so hard to protect. Last month, we celebrated the 10th anniversary of the passage of the Dodd-Frank Act. The Dodd-Frank Act ushered in critical financial stability safeguards, outlawed predatory and risky practices and products, and created the Consumer Financial Protection Bureau, a dedicated agency to serve as a watchdog for our consumers. Congress acted in 2010 to pass the bold and critical reforms in the Dodd-Frank Act following the financial crisis of 2008. In the 2008 financial crisis, trillions of dollars of wealth was lost, and millions of families unjustly lost their homes to foreclosure. At the core of the crisis was predatory, discriminatory lending, in which communities of color were specifically targeted with costly subprime loans. As a result, communities of color were disproportionately impacted by the crisis, and many communities still have not recovered from the massive loss of wealth to this day. Of course, right now we are yet again in the middle of another crisis in which communities of color are suffering disproportionately and through no fault of their own, both from the coronavirus and from the resulting economic recession. As chairwoman of the Financial Services Committee, I've been working very hard to ensure that Congress provides strong protections and relief to the many families across the country that are suffering during this crisis, and that communities of color and low-income communities have access to new and existing relief efforts. For example, when Paycheck Protection Program, that is the PPP, funds were being funneled from big banks to their large business clients, while many minority-owned businesses were shut out, I took action. When the first round of PPP dollars were depleted, I worked very closely with Small Business Chairwoman Nydia Velasquez to ensure the Treasury Department and the SBA, that is the Small Business Administration, set aside $60 billion for community lenders like the Community Development Financial Institutions and Minority Depository Institutions. We also urged the Federal Reserve Chair and Treasury Secretary to make further administrative changes so that programs like the PPP and the Main Street Lending Facility are open and accessible to minority-owned businesses. While these efforts were thankfully successful, many more is needed to support all families, so I'm continuing to fight to ensure that the response to this crisis is robust and equitable. Presently, I'm deeply concerned about the implementing eviction crisis. While the House passed the HEROES Act 81 days ago to provide families with the additional protections and the relief they so desperately need during this crisis, Senate Republicans and the White House have blocked the bill and have done everything to avert catastrophe. And so I'm doing everything I can to make sure that Congress provides what it needs to provide in order to create relief for so many of our families. Unfortunately, even in the face of this ongoing pandemic crisis, when our attention should be focused on how to stop the virus and rebuild our economy, Republicans are focused on, would you believe, deregulation, as they have been for the past 10 years. The ongoing work of defending Dodd-Frank and the Consumer Bureau is so much of the time that we have taken up on my committee just to deal with the issue of protecting the Dodd-Frank bill. The attacks on Dodd-Frank and the Consumer Bureau from Republicans have been shameless and unrelenting. When I became ranking member of the House Committee on Financial Services, Jeb Hinterland was the chairman, and he was determined to unravel as much of Dodd-Frank as he possibly could. So I led the efforts to fend off this harmful deregulatory agenda. And I'm so proud to say We fought his efforts to roll back the law every step of the way. In Donald Trump's first few days in office, he promised to do a big number on Dodd-Frank, and his appointees have worked to carry out that goal. When Mick Mulvaney was installed by Trump as acting director of the Consumer Bureau, he promptly got to work trying to take apart the agency. In response, I drafted and advanced the Consumer First HR 1500 to block the Trump administration's anti-consumer agenda and reverse their efforts to undermine the mission of the Consumer Bureau. That bill passed the House in May of last year, and I'm continuing to work to make sure the Consumer Bureau stays strong. One might hope that during this growing pandemic crisis, the deregulatory efforts would be paused, but that's sadly not the case. Despite the clear need to focus on consumer protection during this crisis, the Trump administration's work to roll back consumer protection has continued. Last week, the Financial Services Committee held a hearing with testimony from Kathy Kraninger, Trump's appointee to lead the Consumer Financial Protection Bureau. So at that hearing, I went over the ways in which even in the midst of the pandemic, Kraninger is working to administratively roll back important consumer protection reforms and destroy the Consumer Bureau from the inside. For example, she has issued a final rule to roll back key safeguards for payday, car title, and installment loans, which expose consumers to high-cost predatory loans that result in a cycle of debt. This is a shameful act at any time, but especially during a pandemic in which consumers are financially vulnerable and struggling just to make ends meet. She also issued an advance notice of proposed rulemaking to make substantial changes to the agency's qualified mortgage rule without robust data or analysis to assess how the changes will affect potential borrowers, especially minority borrowers. As many of you know, the QM rule implements the standard created in Dodd-Frank that lenders must first demonstrate that a borrower can repay a loan before signing the mortgage documents. We created the ability to repay standard in Dodd-Frank specifically because so many mortgage lenders peddled unaffordable loans, no doc loans, for example, interest-only loans, and other harmful mortgage products in the lead up to the 2008 crisis. And yet, in the midst of this pandemic crisis, Trump appointees are working to chisel away at this key mortgage rule. So in addition, Kraninger has weakened the reporting requirements under the Home Mortgage Disclosure Act, commonly referred to as HMDA. HMDA data is an essential tool that is used by the government, researchers, advocates, and others to redirect redlining or just to detect redlining and patterns of discriminatory mortgage lending. A Refo News investigation found evidence of modern-day redlining in 61 metropolitan areas with the use of HMDA data. But again, during this pandemic crisis, Kraninger has prioritized this diminishing access to that data. I am committed to continuing to conduct strong oversight over the Consumer Bureau, as well as the other financial regulatory agencies, and fighting against Trump appointees' efforts to weaken financial regulations. I want you to know that despite Republican efforts to roll back Dodd-Frank regulations, I'm continuing to advance legislation to build on the law and strengthen consumer protections. One area there is much work to do is our broken system of consumer credit reporting. As chairwoman of the Financial Services Committee, I've prioritized legislation focused on credit reporting, including HR 3621, the Comprehensive Credit Act, to make essential comprehensive reforms to the nation's consumer credit reporting system. I'm pleased to say the legislation passed the House in January of 2020. In addition, in June, the House passed bipartisan legislation sponsored by Representative Gottheimer, H.R. 5332, the Protecting Your Credit Score Act, to provide easier access to stronger protections for consumers in our credit reporting system. I am also determined to take action to put a stop to predatory payday loans. This Congress, I've held hearings in the Financial Services Committee on debt traps in the payday and small dollar credit industry, as well as rent-a-bank schemes designed to evade state interest rate caps. And I will be taking action with legislation to protect consumers from predatory payday loans. I've also created a historic subcommittee on diversity and inclusion, which is the first of its kind in Congress. The subcommittee has held hearings on the lack of representation of women and minorities in the whole financial sector, board diversity and the racial and gender wealth gap, diverse asset management, and the lack of diversity in America's largest banks, and released a landmark report on bank diversity data. I'm also very pleased that the committee has advanced, and the House again has passed legislation to require companies to disclose the demographics of their boards and C-suite executives, to require Federal Reserve banks to consider diverse candidates when filling bank president vacancies. So under my leadership, the committee has gotten tough on mega banks that break the law. For example, following a committee investigation in just March of this year, we held hearings with the CEO and board chairs of Wells Fargo on the bank's egregious pattern of consumer abuse. So after the release of the our committee's investigative findings and my call for their resignations, the board chairs of the company and the bank resigned days before the hearing. As part of these hearings, the committee considered several proposals, such as my legislation, the Mega Bank Accountability and Consequences Act, which would require federal prudential banking regulators to fully utilize their authorities to shut down mega banks that repeatedly harm consumers and hold culpable executives accountable. In addition, as the financial services marketplace evolves with the emergence of new technology, I am making sure that Congress stays on top of these developments. I created 2 task forces, one on financial technology and one on artificial intelligence. The FinTech Task Force is examining the regulatory framework for FinTech, how FinTech is using its lending, and how consumers engage with FinTech. The AI Task Force is examining the impact of automation and machine learning and how companies and consumers can use artificial intelligence in the financial marketplace. So let me be clear. The days of Financial Services Committee, been known as the Juice Committee, where members advance bills authorized by special interests, are over. The bills are dead on arrival. Now, with me as chair, we're a committee focused on protecting consumers, investors, and the economy, and ensuring that the financial system is fair. So I want to thank you again for inviting me to join you to discuss the importance of Dodd-Frank and my ongoing work to ensure strong protections for consumers. I'm so appreciative for your ongoing work fighting for a strong financial system that works for all Americans. Thank you so much for inviting me here today.
Thank you so very much, Chairwoman Waters, for your remarks and for your leadership on the committee. We are excited to get to continue to work with you on so many of the important issues you talked about: fighting the payday debt trap, dealing with credit reporting systems, closing the racial wealth gap through a whole variety of tools and really taking on some of the structural problems that enable powerful financial predators to extract money from families and communities. We're so fortunate to get to work with you on those issues. Thank you. And thank you, Hilary, for that excellent introduction and for all of your work advancing justice. Enormously appreciated. Thank you. So I think we will now have a quiet technological switch, and we will begin the next session in just a moment. Okay, good. I think we can begin. It's my great pleasure now to introduce Federal Trade Commissioner Rohit Chopra, who has been serving in that role since May 2018. Before his time at the FTC, he was, among other things, an assistant director and the first student loan ombudsman at the CFPB. And in all of his positions, he has been creative and a rigorous thinker about how to use the tools of government and of financial regulation to advance the public interest. So I'm very excited to talk with him today. Thanks so much for taking the time. So we are talking just a handful of weeks after the 10th anniversary of Dodd-Frank, and Chair Waters and Hilary both just talked about some of the very important pieces of that bill. When you think about the bill and on these 10 years since, what do you think are some of the key lessons to be learned about what worked well and what worked less well in those Dodd-Frank reforms?
Well, first, Lisa, thank you so much for having me and for everything that AFR does and every member of the coalition around the country. I think it's good we're reflecting on passing these laws and reforms that come out of them. I have a couple initial reactions that, one, it's really good when Congress strips authorities from federal agencies that clearly failed. There's just no question that the Office of Thrift Supervision, the Federal Reserve Board of Governors, others, including the FTC, really dropped the ball when it came to monitoring the markets, taking action, instead prioritizing, in my view, an ideology that simply markets will correct themselves and everything will be hunky-dory. And we really need to make sure we're always doing that. When agencies fail, we take away authorities and we conduct vigorous oversight as the public, as the media, and of course as Congress. Now, you know, what are some things that I think we could have done better? I really think a big problem we have in our entire policy-making process is when we give agencies the ability to pocket veto parts of the laws that they don't like, either by not implementing the rules or just not enforcing it at all. The FTC is certainly one of those agencies that sits on a lot of authorities and simply doesn't implement them or chooses not to enforce them. And there's countless examples that I've tried to highlight during my term. And I think that offers some real lessons for advocates, for policymakers, that sometimes we've got to push for laws that are self-effectuating, that there's real backstops in case the agency simply does nothing, which we know happens, and to put more hands, more enforcement powers that are more distributed, not just in one agency in Washington. And we also, I want to jump off of something you said and also Chair Waters said. We really need to be thinking more about structural changes to some of these markets and industries. You know, Chair Waters mentioned the credit reporting industry. You know, we're now at about the 50th anniversary of the Fair Credit Reporting Act. And, you know, I'm concerned that the mere structure of this agency, a three-behemoth oligopoly, where consumers are not the customer, they're the product. It's really hard to fix that when the incentives are essentially all wrong. And we're seeing that play out in our data economy today, whether it comes to Facebook and its controversial Libra proposal, and a whole host of other issues. So, you know, again, really holding agencies accountable, that's a good thing, but moving more toward structural relief and automatic triggers and laws to make sure that we can stop agencies from pocket vetoing some of these reforms.
Thanks. That's extremely helpful. And I think a good pivot to thinking about, specific places where those kind of structural reforms are needed. And one such place that you have recently drawn attention to, you put out a very interesting statement just a little bit before the Dodd-Frank anniversary, connected to the annual report on companies notifying the FTC about proposed mergers and acquisitions. And you took the opportunity of that report to comment on some acquisitions, including by private equity firms, that are too small to trigger reporting under the existing statute, but that nonetheless might pose serious corporate concentration worries. So can you explain a little bit that comment that you made about the roll-ups and why you're worried about them?
Yeah, sure. I mean, I think there's this sometimes a myth that we buy into, which is that firms are all just competing on their ingenuity and hard work. And the problem with that frame is that it ignores the realities of financialization and incentives from Wall Street, Sand Hill Road, City of London, wherever those financial capitals are. And they create a different set of incentives that are disjointed from what the economists learn in their textbooks. Theirs is about maximizing the ability to generate outsized returns, often in a very short duration. And there's really the changes in the nature of private equity that we've seen in the past several years are ones that we should all be quite worried about. You know, Eileen Applebaum and others have done some great work thinking about how private equity firms are not necessarily doing what they, maybe used to or what they say they did, which is come into a company, provide some extra capital, be patient and let it grow and invest. That's not the model of a lot of the Wall Street-oriented private equity funds. Many of them are strip and flip, the ability to be able to get control of an asset, drain it through monitoring fees, consulting fees, selling off land, and then sometimes bankrupting the company while still making a profit. But another key way that they're really, certain funds are really monetizing this is to create market power and dominance. And we see this in a specific type of acquisition strategy that is really all over the United States and increasingly all over the world, which is the private equity roll-up. This is where a fund will purchase dozens or even hundreds of small firms, combine it into one gigantic one, and then sell it off at a big multiple. And it may sound technical, but I really want us to all appreciate this concept of multiple arbitrage, where a company, their valuation might only be 3 or 4 times their earnings or their revenue if they're a smaller firm. But because of a lot of macro issues, including the Federal Reserve's interventions, we're seeing the bigger companies trade at much bigger multiples. So the recipe then is, okay, without really even improving a company, investing in building plant, equipment, hiring jobs, we can cobble together these little companies, create more market power and dominance, and then exit at a big fat profit. And one of the things I've been arguing for is more scrutiny over these roll-up deals. In typical merger notification, a company that when you do a transaction, you only have to report it and subject yourself to a waiting period if it's over a certain threshold, generally around $94 million. But many of these acquisitions fall below the radar, even though they might, again, be dozens or hundreds of them. And there's no bigger impact I see than what's happening in the healthcare sector, whether it's the roll-up of opioid treatment clinics or dialysis clinics or even in what we're seeing today of purchases of physicians' practices. And, you know, many physician practices and others are really starving for cash right now because while there's a lot of healthcare expenditure, it's not going to a lot of doctors, dentists, and others. And so many feel that they're going to need to sell to one of these funds. There's a great Journal of American Medical Association write up on this, and it's a big concern for quality of healthcare as well as cost. And so we really need to confront this head on in terms of administering our antitrust laws and not just buying into every firm is the same. They all act the same way. They're all profit maximizing in the same way. They are each motivated by a different set of incentives, and especially when they're highly skewed by some Wall Street-oriented tactics to quickly monetize, even if at the expense of long-term growth.
Yeah, that's very, very interesting and helpful. I wonder if there's anything more you want to add about health, this issue in healthcare in particular. I know that you know, we and everyone are paying particular attention to the healthcare system in the context of the COVID crisis and the way that in so many ways it's kind of amplifying as well as revealing existing problems and existing injustices. And one place, for example, that's coming to our attention is nursing homes, where there's a lot of academic research over the past, I don't know, 10 or 15 years about the ways in which private equity owned nursing homes have lower staffing levels, higher level of deficiencies, worse patient care. And we are looking now at how that plays out in this moment and the ways in which those kind of short-term, incredibly financialized incentives translate into harm for both patients and workers. So just interested in whether, from your perspective, there's anything more about healthcare in particular.
I really see a common through line in terms of a lot of leveraged buyout funds in several sectors. You know, I've worked with you and many others at AFR on private equity owned for-profit colleges and universities. We obviously see big issues in private equity owned retail. And I see some similar issues when it comes to healthcare, which is that the key is to use some of the core incentives to very rapidly grow revenues and increase margins, but often discounting some of the quality and sustainability aspects that ultimately harm, you know, patients, students, workers, whomever it may be. And I think that is something that warrants much more scrutiny, whether it's on the antitrust side, whether it's on how these firms are regulated. And I worry that we are not appreciating these incentives enough. Think about what we're dealing with when it comes to PPE and our healthcare industrial base, our defense industrial base. The incentives for many of these funds to rapidly increase the valuation is going to favor oftentimes offshoring, reductions in capacity, and ultimately that makes our economy less resilient to shocks, creates shortages, and ultimately harms all of us. So I think we have to really start thinking about antitrust and financialization together to figure out how ultimately we're going to restructure some of these markets and the underlying incentives so that they don't keep exacting harm on all of us. I'm so glad you mentioned the part about nursing homes. You know, what we're seeing in nursing homes, you know, some states right now, I've been looking at the data, over 1/3 of the fatalities are happening in these facilities. And you really worry that when there's a huge profit motive to, you know, jack up, you know, patient counts and billings, it can come at the expense of, you know, what really the mission of some of these entities are. We saw this a few years ago in some of the roll-ups of opioid treatment clinics. I have been concerned that just spawns all sorts of predatory behavior, including the body brokering practice, where essentially it's giving big commissions for referring those suffering from substance use disorder. So all of this is highly problematic, and I think we're going to need to think, for all of us who care about reforming the financial system, for everyone who cares about our core industrial base and production base, for everyone who cares about jobs and workers. I think we all have to kind of come together to strike at these solutions using a different framework than maybe we traditionally have.
Thanks. That's super helpful. And I want to come back to the framework in a moment, but I want to give you a chance just to tie the pieces together in one more way and go back to what you said at the beginning of this set of comments around private equity and for-profit schools. I'll note that private equity is also a very large owner of payday lenders, that Chair Waters was talking about abuses in that sector. I don't know if there's any additional insights on the ways in which large players and financialized players can kind of supercharge abuses in what's already a really problematic industry, that helps to shed light on how we should address these problems as well.
Yeah, and I think no one is arguing against, sometimes people with private money coming in to help expand a business, build a business. If people, we know this, people in the neighborhood pitching in to help start a new store, restaurant. I think what we're seeing, this is turbocharged on steroids, that is some of the bottom feeding. One issue I see that we need to take a hard look at is dividends and payments that are rapidly extracted by funds. We see it in all sorts of Byzantine billing practices on how funds charge their portfolio companies, taking out dividends. I was very concerned and voted against merger approval related to a private equity fund, Sycamore Partners. In many ways, quite an infamous fund. It had assembled an office supply business, Essendon, and had purchased Staples. And soon after the merger closed, they just gave themselves a massive dividend, almost replacing their initial investment, such that even if it failed, they wouldn't lose a dime. We obviously need to look at how workers and their pensions, where do they fall in the stack? Because when these portfolio companies go bankrupt, who ends up losing and who ends up winning? So there's really a lot we can do there, but I hope that we want to really prioritize the antitrust dimension of this and the market structure dimension, bringing more cases on roll-up deals, scrutinizing divestiture buyers when it comes to merger remedies and the unique incentives that private equity funds have, and taking a deep dive on another big element of where private equity takes advantage, and that's when it comes to government subsidies. Whether, a lot of focus on tax loopholes, but look at how the Fed credit facilities that are being used, Main Street facilities, supposed to be going to, real businesses, how much some of those benefits are flowing to this type of business model to engage in more acquisition sprees. The Fed's purchase of junk bonds. Now, obviously, there's all sorts of reasons why they're justifying this, but when it has a kind of no strings attached approach, you just worry that it's going to elevate a lot of the bottom feeders who are just exploiting government privileges and benefits. So I think of it in two ways. Those are the two big things: how they extract cash and capital out, as well as how they take advantage of government loopholes, privileges, and benefits in many ways at the expense of workers, consumers, and the real productive base of the economy.
So you started to get at talking about solutions in some of what you just said, as well as problems. But I guess I have two follow-up questions on to what you just talked about, and one is about what else you would want to add about what tools are already available? What tools do we already have, or do the banking regulatory agencies have, the SEC, the FTC, Treasury, that they could use to take on some of these abusive practices that are enabling or incentivizing extraction? So anyway, that's one question. And then a second that your comments just now reminded me of or suggested is that, private equity was growing already before the last financial crisis, but was really exploded after it. And what was a devastating moment for many families and many communities was an opportunity for them for expansion and growth, including, for example, in housing markets where families losing their homes became a place to swoop things up at bargain prices, and now
Yes.
practices that are contributing to the affordable housing crisis. So how do we, these are two very big questions, but how, especially in this moment, do we keep this crisis from making this situation still worse than it is already?
Yeah, I think part of it is we all are going to have to, I'll start with saying I want the Commission and the Justice Department and the state AGs, we got to start bringing more antitrust cases on anti-competitive conduct, challenging some of these mergers. Of course, the bank regulatory agencies, especially the Fed, the extent to which there are these massive rescue programs, really putting some strings on them to make sure that it's not just going to make powerful funds and firms even richer. And of course, the list goes much longer when it comes to taxes and a lot of the other benefits that are exploited. So, I think there's a long list. There's a lot of things we can do. I do want to say, we are seeing a movement away from transparency. The Securities and Exchange Commission recently proposed reducing disclosure under the 13F regime, which is how, many hedge funds, private equity funds, and others disclose their holdings. The less information we have, the harder it is to watch over markets. And, we got to be concerned about any time we're putting darkness when we're trying to get going on greater enforcement and oversight. And I also really think we have to start thinking about the role the states are playing, Lisa. Been watching carefully, the state of Washington has been implementing a new merger reporting law focused on healthcare. That means that the state AG will get more insight on those deals and can block more of them. I really encourage others to think about what more we can do at the state level to build a backstop in case the federal government just simply, doesn't do anything. And I know that the issues of concentration and market power and abuse of that power are increasingly of concern at the state level. And the more that we can equip local communities and cities and states with those powers, they won't just have to rely on Washington to put a stop to it.
Very important. I think one other place where there's a lot of potential in the private funds realm for state and local action actually is around transparency, because the information that's provided to investors, to public pension funds, often is terribly inadequate in terms of the actual returns and actual costs, and really changing that regime would change the power balance there. So there's a set of tools that regulators have already and are not using effectively to take on these problems. But in addition to those tools, I know that you and I both think that we need policy changes. We need more tools, and we need policy change to create those and to make structural change to actually take on these problems effectively. Can you talk a little bit about what you see as some key policy changes needed?
Yeah, I'll talk broad brush about across the board, whether we're talking about large, powerful pharma companies, technology firms, financial institutions. One, we need to really go after the inherent conflicts of interest that are in some of their business. And that means looking harder at structural separations within firms. That means that when there is that conflict of interest, in some ways thinking about Glass-Steagall type remedies for other sectors of the economy. We have known for generations, for example, in the Communications Act, we have separated certain parts of telecommunications businesses. We don't allow certain types of cross-ownership. We don't allow access to certain types of data by certain players. So I think thinking through how we make sure that certain activities aren't commingled, and you saw this in a lot of the public debate and questions with respect to large tech companies. If you're a dominant platform, should you also be able to be a participant? Does it make sense if you're both the player and the referee? I think that applies to so many things that we've mentioned and need to tackle. I also think we need to start looking more at how we are ultimately reducing the excesses of and abuses of market power. Sometimes that can mean spinning off, breaking up firms to make sure that there's more competition. Often it means taking a harder look at merger review. Obviously in the banking sector, the Truist merger got a lot of scrutiny, but ultimately went through. So looking at kind of that market structure and how it's regulated to avoid conflicts of interest, to avoid excessive market power in terms of size and scope, and also to really, again, I want to go back to something else I said, abuse of government privileges. So in as much that they are using government benefits such as patents, trademarks, if they're using that to violate the law, we have a lot of history in this country of opening up those patents or opening up licensing or not creating more open access so that larger behemoths can't use that control to create bottlenecks and ultimately to choke off and bully small players or new market entrants. So I know that's broad, but I think we need to think about this kind of structural approach rather, and we could apply it to some of the issues in credit reporting, a lot of the issues in financial services. And I think that broader view, rather than, and building on some of the things that we've done in terms of disclosures and, fairness, I think we have to take both approaches, but ultimately attacking the business incentive that creates the harm is just really critical.
I think part of what's so interesting about what you're saying is there's a sort of through line about incentives at multiple levels and the way that structures create pernicious incentives. And then I think it's really sometimes the conversation about corporate concentration is a very separate conversation from the conversation about Wall Street's regulation or financial reform. And I think part of what's powerful and interesting about what you're suggesting is some of the ways of thinking about those together, asking questions and thinking about solutions in ways that think about the problems and the tools in an intermingled way. So I don't know if there's anything else.
Yeah, I think that goes in terms of our structural solutions, but also in terms of enforcement. So I have been a strong advocate for more individual executive accountability. I think we have a double standard in Washington where small firms, when they get in trouble, we sort of investigate the CEO, we will name them and we will sanction them. And in some cases, with the largest, most powerful firms, we don't even interview or depose the top executives. We saw that in the SNL crisis, hundreds of executives even jailed. But in the 2008 crisis, a very different approach was taken. So I think making sure that we're putting individuals on the hook when they've broken the law and not to have that double standard feels very important. But you're right. I think in banking, banks receive a lot of public benefits, deposit insurance, access to the Fed's discount window. And I think the Wells Fargo scandals really put this in full view. all of the government contracts they receive. And there's a certain question where you have to ask yourself, if a firm is violating the law repeatedly, why are we giving these government benefits? Why are we not restructuring the firm so that we send a clear message that it's a privilege, not a right, to have some of these benefits, and those benefits are granted by us as a public to promote a growing economy, not for an individual executive or a board or a set of shareholders rent seeking. So I think we got to apply that same mentality often when it comes to enforcement, and not have this double standard of going after small time scammers with a sledgehammer and giving a pat on the back to, you know, a big corporate executive.
I think it also is about not having a regulatory system that kind of endorses and is comfortable with repeated privatizing of gains and socializing of losses that's deeply related to that. So I know we need to wrap up, but a final question that I think what you just said was a very good transition to, which is, you know, thinking even more broadly, reflecting on your experience as a regulator, what should we be asking of and expecting of financial regulators and other regulators whose work impacts finance in terms of how they can and ought to contribute to advancing economic and racial justice? What should they be bringing to these roles, and what should we expect of them?
Yeah, we need, I think, to make sure that the next round of this fight is not just relitigating old battles. It's really with identifying some of the systemic problems we have and tackling them head on. You know, you mentioned obviously discrimination and injustice. What are we going to do when it comes to algorithmic discrimination, machine learning, artificial intelligence? I have written about the need to use unfairness doctrine that can be used under the FTC Act and the CFPB statute to go after some of that. We need to think more than just, for example, individual clauses in contracts. That's often an obsession of many of us. But why don't we think bigger about unfair contracts writ large? We see in other jurisdictions, including the UK, Australia, New Zealand, looking at contracts holistically and banning certain terms altogether, making some inherently suspect, and essentially reducing the power that certain firms have to dictate and control, whether it's in a financial contract, whether it's in a worker contract, or whether it is in a contract for a small supplier or farmer. All of it is about abuse of power, and fundamentally addressing that, I think, is core to both economic and racial justice issues right now.
Thank you so much, Rohit. So glad to get to continue this conversation with you, not just today, but you know, in the time ahead, and to figure out how we can actually make some of these changes happen. Really appreciate your having these conversations.
Thanks again for having me.
All right, I think we will now perform technological magic, and I will turn the floor over to my colleague, Rion.
Hi, welcome, everyone. Thank you, Commissioner Chopra and Lisa, for that fascinating conversation. And now we'll turn to our 10th anniversary Dodd-Frank panel discussion. We are joined by 4 illustrious panelists. We'll start with Rich Dubois, who is the executive director or president of the National Consumer Law Center, Professor Arthur Wilmarth from George Washington University, Greg Jefferson from the AFL-CIO, and Christina Livingston from ACE out in California. So thank you, everyone. I hope all the technology is working as it should, and our audience is locked in, and we'll get started. So I think we'll start with, we'll start with our first question, and we'll just hop right into it. And so the first question, I think, is what are the key problems with the way the banking and financial system works now after Dodd-Frank? And so I think we'll start with Professor Wilmarth. Go ahead, Art.
Okay, thank you.
And we'll go around to each of the other panelists to hear their thoughts on it. And so, but the floor is yours.
Great, thank you very much, Dennis. I hope you're hearing me okay and seeing me all right as well. Thank you so much for inviting me to participate, and I'm very appreciative to Americans for Financial Reform for including me in this program. Some of my comments, I think, follow up on some things that Commissioner Chopra was mentioning. I think we have some major structural problems that we need to look at because Dodd-Frank, for all of its virtues, did not change the basic financial structure of the system that brought us the global financial crisis of 2007 to 2009. We went into that crisis with a system that was dominated by large universal banks. Those are commercial banks that are also engaged in capital markets activities such as securities underwriting and trading and so on, securitization of loans, and by shadow banks. The shadow banks at that time, the main ones were the five major securities firms. Three of them essentially failed or were acquired. The other two, Goldman Sachs and Morgan Stanley, converted into banking companies. The major shadow banks today are essentially the private equity firms, the hedge funds, other asset managers. Money market funds have continued to be an important shadow bank, which has been certainly problematic. So we had a very unstable system, as 2007 and 8 and 9 showed. Basically, we tried to tweak that system with literally hundreds of highly technical reforms. Certainly, improvements were made, but we have the same basic system. So what happened when the COVID pandemic hit? The system proved to be just as unstable. More of the problems appeared in the shadow banking system, but I think it's pretty clear, and we could talk about this later, that had the Fed and the federal government and other governments and other central banks, had they not intervened as aggressively as they did, you would have seen severe problems in the banking system quite soon. And we're not sure, of course, whether we're out of the woods yet on that problem by far. So what does this system create? The system creates, essentially, in my view, a structure in which finance flows heavily into capital markets, speculative activities. To say that private equity funds and hedge funds are probably the most important shadow banks tells you a lot, because as Commissioner Chopra mentioned, those companies are involved in highly aggressive transactions, highly speculative transactions, trying to extract as much money as one can extract by taking speculative positions over the short to medium term. What about universal banks, the big guys? Wells Fargo was mentioned, but one could look at JP Morgan Chase, Bank of America, Citigroup, Morgan Stanley, Goldman Sachs. None of these banks has a relationship-based model. If you go back 50 years, 75 years, banks were much more of a relationship-based business. They had long-term relationships with their customers. They were not essentially taking loans and securitizing them into the capital markets for fee income. They were essentially making loans at different terms, but they were basically intermediating, holding them, forming a relationship. Relationship-based finance basically has almost disappeared, except in sectors like the community bank sector, the credit union sector. Small banks still have that approach, both with consumers and with small businesses, but the big guys don't. It's a transaction-based business, basically move the money to the highest bidder. Well, what kinds of things other than leverage buyouts and so on does Wall Street tend to get into? Well, they provide money, for example, to marketplace lenders, right? The payday lenders, the auto title lenders, those guys are all funded by Wall Street. That, I would submit, is not a very attractive or admirable system of finance. We see this proliferation of high-cost transaction-based finance, which is produced by this system, and we also see a system that is so unstable that at the least stress, the government and the Fed and other governments and other central banks have to rush in and prop it up. Why would this system be viewed by public policymakers and by the public at large as being an attractive system that should be preserved? I think it's a fundamental question that we need to look at. Why do we still have this system when it basically has failed the last two tests that it has encountered, and it's also, in my view, inflicted a lot of harm on people along the way, even during good times.
Yeah, and that thank you for that, and that's a good, I think, jumping off point to going to Christina. That's a good kind of overview of how the system and the problems that we have in the system that we've created. But Christina is someone that works with regular people every day, and how that system impacts them. What have you seen in your experience of the key problems in the current financial system that we have for regular people as they engage with the financial system?
Thanks. As you mentioned, I work with low-income folks. I work with everyday people, and they don't understand the systems. That's on purpose. They're not intended to understand the systems. It's a lot of work to understand the systems. What they understand is their day-to-day interaction with their bank, if they can be banked, because there are still so many of our folks who are not able to be banked. And for those of us who are able to get banked, it is still the case that, fees are pulling the small amount of money that folks have access to, most of which is not expendable income, which is money that they actually need to pay their bills, to pay their rent, actually putting them into very dangerous positions where they're not able to make those payments. We find situations where we've got folks who actually want to work with the bank to get a loan. Maybe it's for a car, maybe it's for a business, but because of all of the other sort of racialized capitalist systems and indicators that are put in place, they're knocked out of those opportunities, or they get those opportunities and the fees are so high that they, again, are just being leached of it's not wealth that they have, of the money that they're able to pull together to pay for their basic necessities day after day. For folks who are not able to access banks, they are, they're having to rely on really predatory systems that continue to exist. Title loans, car loans, trading in their car titles for cash payments to repay them back with really high interest rates. We've seen these payday lending schemes forever. That is still really rampant in our communities, and it is still something that our folks rely on because they've got so little money to draw from in the first place, and because the fees related to everything keep them in the cycle of debt. That has not gone away. We see a lot of people having to rely on, if they can get access to it, rely on credit. And again, they are experiencing credit payments with the highest fees possible, even though they have the lowest income possible. So in every instance that they are interacting with banks and financial institutions, they are finding themselves in the least advantaged positions of being able to build their credit or pay back the fees, and finding themselves in really sort of precarious situations that are dangerous to them. And there's one particular piece that I want to point out, and most of our folks don't actually realize that they're interacting all the time with private equity firms. But there are Wall Street landlords that have bought up our communities, and they played an outsized role in figuring out how those communities then become gentrified as development is taking place. I live in California, so I'm talking about places like West Oakland, which is a historically Black community. I'm talking about East LA, which is a historically Latinx community, but very, very low-income communities, which are now being gentrified. And along the way, it's not just that they were increasing rent so that people couldn't pay them. They were also finding all kinds of ways to find, to extract, you know, fees and fines and penalties from the members who were able to stay in those homes, and driving many, many more of them out into the streets into homelessness. So it's not as though the banks or these financial institutions are only interacting with people in terms of the exchange of money. They are actually having real impacts on their ability to live in a stable and safe home, to, you know, pay for their utility bills, to get access to clean water, et cetera. So we do a lot of work to try to unmask the way that financialization is not, you know, sort of the interaction when you put your check into the bank and then take it out, how it's like has real impacts and rippling effects in other areas of our lives.
Thanks so much. And so going to Greg, kind of looking at, I know, working at the AFL, you all engaged on many different aspects of how the financial system affects workers and affects working people. And so I just wanted some of your thoughts about the kind of approaches that were taken in Dodd-Frank, and and how you view how it has set up the last 10 years for, I mean, working people, and kind of presuppose the environment that working people will be will have to contend with as they try to get ahead.
Thank you, Ryan. Thank you to AFR and Lisa and, you know, all the staff over there. You guys do an excellent job of you know, making everybody aware of some of these very important issues. The Act did a lot. Dodd-Frank did a lot to Wall Street to rein in Wall Street excess and prevent banks from preying on working people. And millions were, you know, being systematically taken advantage of after years of deregulation. I believe the centerpiece of the law, the CFPB, did an excellent job of protecting working people from the risk and traps in consumer financial products that we often saw in mortgages and credit cards. Though, as the professor and Christina have just pointed out, you know, while we did a laudable effort in trying to correct these problems, they unfortunately still exist. So in short, I think the Dodd-Frank attempted to, you know, make it an even playing field for all the players involved, and it's quite a heavy lift. And unfortunately, when you have a number of people trying to prevent you at every single, you know, turn, we saw that then, and we're continuing to see it. It's a problem, but nonetheless, I think the Dodd-Frank at least attempted to take on that very important task, and it's ever going right now.
Thanks, Greg. And coming to you, Rich, at NCLC, I mean, I think you all have, I mean, just the kind of bird's eye view of policy and as it affects working people. And so if we can get your thoughts on what worked well and what didn't work well in Dodd-Frank.
Sure, thank you, Ryan. So I think I agree with a lot of what has been said before by some of the other panelists and by Rohit and Chair Waters. I like to look at Dodd-Frank in the longer context of history, and I see it as a really important step, but by no means, you know, are we there yet? As I think we've heard clearly, there's a lot that needs to be done. But I do think it's important to recognize that it was really the first time we stopped the deregulatory agenda. You know, the previous 30 years, everything had just been loosening and loosening. We had the Credit Card Act in 2009, and then Dodd-Frank in 2010. So I think that just needs to be recognized for what it was and how important it was at that time. It clearly established a consumer bureau that was focused on protecting the consumer first and was not going to be part of some other agency's activity, but it was going to be the central mission. And I think that is incredibly important to recognize. When the idea first came up back in 2007, when then Professor Elizabeth Warren raised it in a law review article, people did not think it had any chance. It was a pipe dream. I can remember us talking about it in our office, and just it was a dream that we didn't see, you know, coming true. But 3 years later, you know, it was passed into law. So that was an amazing moment, and I think we need to, you know, recognize that. In terms of, you know, some specifics, you know, in the mortgage area, I think, you know, given the fact that the subprime mortgage crisis was such a driver of the whole financial crisis, it made sense that mortgages were dealt with more directly in the bill. Chair Waters referred to this earlier, you know, the ability to pay standard in Dodd-Frank was really important to have that established. So I think that was, you know, something that was really important, you know, to stop the no doc, you know, interest only type loans that were so prevalent, to, you know, to make lenders actually demonstrate that the borrower has the ability to repay the mortgage. So on the other hand, I think, you know, some of the things that Christina was talking about in terms of what we're seeing in the community, you know, is evidence that there's a long way to go. You know, Dodd-Frank did not deal with, you know, high cost lending, payday lending, triple digit interest rates, you know, some of the most outrageous, you know, predatory lending that goes on. So, you know, there's no interest rate cap in the bill. That's something that, you know, we have been pushing for some time, and really think is important to have a 36% interest rate cap, similar to what we have for service members, but to extend that to all loans. And then something Chair Waters referred to was the, you know, the rent-a-bank schemes, and how you're getting predatory lending on the backs of these national banks that are partnering with predatory payday lenders in many cases, and allowing for these very high exploitative interest rate products to be sold in the community. So, those are some things I think, you know, clearly were not addressed, but need to be addressed, and you know, disproportionately affect communities of color by far.
Okay. Well, thanks, Rich. We're taking the panel in alphabetical order, and for the second question, we're going to go in reverse alphabetical order. So I'm going to come back to you, Rich, again with this one. But what are some of the key changes to the financial system that are needed to make the economy work better for most people?
Sure. So there's a long list of things that we'd like to see done. So I won't go through everything. You know, that's on our website. I'll mention just a few things that I think are important to note. The student loan crisis is something that I know a lot of people are very aware of. You know, it's $1 trillion debt load that our students are you know, weighed under by. And so we need to reduce the burden of student debt. I think that would have a huge impact on the broader economy. It's an issue that, again, disproportionately affects communities of color in terms of the burden of student debt. So we think there should be some broad cancellation of student loan debt. It needs to be comprehensive and on a large scale to really make an impact. You know, there's some other things that need to be done. Student loans are one of the few debts that can't be discharged in bankruptcy. So, that's really important, among all the debts that people have. We think that's something that needs to change and needs to change right away so that someone who's, in real financial trouble really can get a fresh start. That's the whole point of being able to have a bankruptcy option. So we think that would be really important. And we think you should stop seizing people's wages to pay for student debt, seizing their Social Security. Even the earned income tax credit can be seized to pay for student loans in default. So things like that would make a real difference to low income and working people. Kind of along the same lines, there are just a lot of people who have other kinds of debts, not just student debts, but debts from credit cards. Medical debt is a huge problem. It's a big driver of overall debt collection. And so these debts are leading people to lose precious income and money in their bank account that they just can't afford to pay for necessities. So we really need to change the system for protecting that precious income and assets that people need to survive, and not allow creditors to seize someone's Social Security check or just the wage that they've earned at a minimum wage job. So in addition, the last thing I would say that's kind of a broad change that would have ripple effects across kind of financial services would be the practice of forced arbitration in consumer contracts. That's something that I think a lot of consumers don't pay a lot of attention to. They're, you sign on the dotted line, you hit accept now online. People aren't reading the fine print. It's really buried in these contracts, but it has a huge impact. It prevents people from enforcing their rights, and they have these private arbitration forums where the company chooses the arbitrator and they don't have to follow the law even. So people are signing away their rights, and it will affect things from student loans to bank accounts. It'll affect employment contracts, nursing home contracts, you name it. Storefront payday lenders use them very widely. 84% of payday lenders in one survey. Companies like Equifax and Wells Fargo have used them. They're throughout the economy and really affect people's ability to enforce what rights they have, hard-earned rights that are in statutes that have been passed by Congress. So I think that's something that we can't overlook and really need to see that changed so that these arbitration agreements are no longer allowed to be put into consumer contracts.
Thanks, Rich. Turning to Greg, what do you think are some of the key changes to our financial system that we need to address growing inequality in our society?
Such a juicy question, Ryan. Should I start with income inequality or racial inequality, economic inequality? I guess I'll start with economic inequality since we're talking about finances. But I believe really, all of them are arguably all connected. And I think we're seeing that more in the pandemic has really enlightened us to the mass inequality that we have out there. As far as economic inequality, the wealth gap between America's richest and poorest families is more like doubled since the late 80s, I believe, the last study I saw. And this inequality is even more alarming when you break it down racial lines. So we frequently see signs of inequality in the banking arena with the lack of bank access that Christina was just talking about in minority and low income communities, where many are forced into cycles of payday loans and check cashing fees and interest that I think they say can cost families up to $2,400 annually, which is a lot of money when you think about the modest income that a number of families have nationwide. Then there, of course, there's inequality in home ownership, with the home ownership rate for African Americans standing at about the same level that it was when the Fair Housing Act of 1968 was passed, which is just insane. I saw a quote the other day, a report that the wealth of Blacks in Boston is something like $8 compared to several hundreds of $1,000s for whites. So, you know, there's inequality everywhere that we're seeing, and unfortunately, it's something that needs to be changed. And then I can't forget income inequality. You know, the AFL-CIO, we're always pushing for wages. Like the top 1% of income grew like 5 times as fast as the bottom 90% of income. So it's inequality that is really doing us injustice in society right now, and needs to be addressed. And, you know, we're all trying to, you know, address these concerns.
Thanks, Greg.
Mm-hmm.
Christina, can you speak to, I guess, specific changes you'd like to see to address those racial inequalities that we have that show up in income and wealth and housing and in every manner of disparity right now, that as we look at the issues?
Yeah, well, I'll start by saying, you know, given the history of this country, you actually have to work really hard to not exacerbate those inequalities. It's not like you can just make no decisions and you'll be sort of flying even. Every decision that we make that doesn't have a screen that's about reducing inequality will exacerbate it. So, you know, and what I'm not saying, what I'd love to see is, you know, required in every financial institution, some sort of like racial equity department with real teeth that can both propose and veto any policy or any product that actually will exacerbate the inequalities that we are seeing, and force, you know, institutions to be meeting not equality standards, equity standards by race, by gender, you know, by all of the ways that they divide us up, and we're seeing inequalities. I think that there's a real problem with, there's a danger. So there's the ability to pay piece that I think is important. There's a danger with the indicators that are being used to determine whether or not someone has the ability to pay, which oftentimes are actually more indicators of the racial inequality that currently exists, like credit scores. You know, my mom, back in 2009, was living in a home renting. The homeowner went into foreclosure and offered to short sale the home to my mom. She, despite, you know, living most of her life right at the poverty level, was able to, over years and years and years, you know, get a little bit of a nest egg through her retirement of her job working in a factory, and had the money to give the down payment for this home, but did not have the credit. Therefore, she was not able to purchase the home. I fortunately was able to purchase the home. Currently, my mom pays the mortgage note. You know, she maintains the house. She's never been late on a payment, but she was taken out of the running because of a credit score, which was, you know, the vestiges of years and years and years of her not having access to credit in the first place, and then struggling to make do. So those kinds of indicators are actually not indicators of whether or not someone has the ability to pay. And we've got to be really careful about what we are saying are those indicators. And then the third thing I would say is that, you know, we obviously need really bold, we can't be tinkering around the edges here, right? I mean, if we're talking about equality and equity, these are not small changes, these are big changes. So the notion of the secondary market in the first place, that people can sort of gamble with folks' actual lives, with their homes, right? We said, okay, you can't do this around mortgages, and then we just let them do it around rent. I just feel like we've really got to rein in what people are allowed to move around on the secondary market at all. I don't know, you know, these are the kind of, I think, big scale changes we need to be thinking about. And the point of the racial equity departments, or the equity departments in general, is that we actually have to meticulously be combing through every existing policy, every existing, you know, product, and be making changes, because it's pretty much a guarantee that in every single one of them, there needs to be some changes and tweaks if we're actually going to get to reducing disparities.
Thank you so much, Christina. I think you're definitely right. I'll take a bit of moderator privilege and say one of my favorite sayings is anything in America, like, because America is such a racist country, anything that isn't specifically anti-racist in its mission as an institution will fall short on addressing that inherent racism that is just has been part of our system until it is addressed. So, okay. Next, we'll move to the third question, and these are going to be more specific questions for our panelists based off of their expertise. I think we'll start with you, Christina. As the Dodd-Frank Act was a response to the 2008 financial crisis, and at its heart, that was a crisis dealing with housing. What lessons have you learned in your work advocating for working people around housing in America in the post-Dodd-Frank world, and now the soon-to-be post-COVID crisis world?
Thanks. I'll just start by saying the current wave of evictions that we see coming really is frightening in a way that, like, you know, I did organize around the last crash, and, you know, homeowners lost generations of wealth, and we saw, you know, folks be pushed into tenancy and, you know, sort of lose any nest egg that they had, any bright vision for the future of themselves or their kids. Unfortunately, we've gone a layer down. And now we're talking about people who are not going to be pushed into tenancy. We're talking about people who are going to be pushed into homelessness. We're talking about people who are going to be pushed into death. And the fact that we have, again, I live in California, so little access to move the political or the private will to build housing that is affordable to folks in our communities. And the fact that there was very little political will to do things like cancel rent, cancel mortgages, make sure folks have guaranteed incomes in this moment, does mean that we are headed toward we have a 30-day cliff that we are, you know, got our foot down on the pedal, smashed to the ground. So what we're really thinking about is, how can we move move property out of the speculative market and into community control? How are we able to make sure that people can at least have, at a minimum, housing that is guaranteed to be affordable, no matter what kind of craziness happens around us, through no fault of our own, or through sometimes, you know, our own sort of mistakes? That happens. So for us, we're thinking about what is the ecosystem of structures that we need to put in place to get there. There are land trusts that we're trying to make sure that are established and are robust enough to be able to bring in properties. There are, you know, policies like Community Opportunity to Purchase Act, so that folks are not losing at the courthouse steps to the private equity firm who's coming with cash, as we saw, you know, back in 2010, 2011. And we need public banks. We need banks who actually have, as part of their bottom line, the responsibility to the communities in which they exist, not just at the state level, but at the local level, who will lend so that we can actually get acquisition funds to take these properties off of the private market, who will lend so that we can develop not affordable housing in the way that we've talked about it, which is not affordable to the folks that I organize with, but housing that is affordable to the people in those communities. So we actually need banking institutions that are part of the community, that have the capacity to, you know, deal in the way we need them to deal, and to live in ecosystem with these other structures that are about actual community control for our folks.
Oh, thank you for that answer. I have to apologize. I think, Art, I skipped you on the last question, so I'll circle back, but I think it falls well in line with Christina's answer. But what are some key changes to Dodd-Frank that you think are necessary to address the instability within our financial system?
Well, thanks, Ryan. Not a problem at all. So I think, you know, some of the discussions we've had are, you know, good things that Dodd-Frank accomplished, primarily through rulemaking. I think the CFPB accomplished between 2010 and 2011, when it was set up, 2016, was very impressive. Certainly, what the bank regulators did in terms of requiring the banks to have more capital, more liquidity, again, between 2010 and 2016, was quite impressive. Not enough, but quite impressive. The problem was, of course, things that are done by regulation can be undone by regulation, or in some cases by legislation. So, for example, the CFPB actually did adopt a ban on mandatory arbitration, and I agree with Rich, that would have been one of the most important things that could have been accomplished. And of course, then Congress overrode it, and unfortunately, it was a bipartisan vote to override it, which I think was a real tragedy. More recently, they've overridden the new director of the CFPB basically gutted what Rich Cordray had done on payday lending, which again was significant, but basically has been gutted. And there have been rollbacks in terms of less capital, less liquidity, and alarmingly loosening up on the Volcker rule, which was essentially trying to keep banks out of the speculative business, basically making speculative trades. The Volcker rule was never, in my view, terribly effective, but what it did do is now being effectively rolled back. So my overriding problem with Dodd-Frank is that it requires constantly vigilant, constantly strong, constantly effective regulators, and that's hard to expect as politics change and as the industry, these giant industry players just relentlessly lobby and also offer very lucrative revolving door contracts to regulators. It takes something of a superhuman, I think, self-denial not to enter the revolving door. I know a few regulators who didn't, and I admire them tremendously. But it's, if you look at the regulators who were there in the early 2010s at the senior level, how many of them did not go through the revolving door? It's a fairly small number. So my view is we need something far more robust and structural. After the Great Depression of 1929, 1933, which was truly devastating, mainly because the Fed at that time didn't act much as a lender of last resort, and the government didn't really do very much on a fiscal basis until 1933. You had a truly devastating, catastrophic collapse, and there was therefore political will to do something really quite dramatic, which was the Glass-Steagall Act. So the Glass-Steagall Act did a number of important things. One is it basically said, we're going to insure bank deposits. We do not want people to lose their life savings when they put them in banks. So the FDIC was born in 1933. It did two other really important things. One is it said to the banks, you cannot be involved in the securities business. If you're going to do banking, taking deposits, which are now federally insured, and making loans and providing fiduciary trust services, you're not going to be involved in speculative capital markets activities. You can't underwrite securities. You can't trade in securities. We want you out of that business. And it said to the securities people or the capital markets people, you cannot be engaged in anything that looks like deposit taking. Now, what would we understand as deposits? Essentially, short-term money, I would suggest money payable in less than 90 days that essentially is close to cash equivalent. So the securities firms couldn't fund themselves, with overnight hot money. They had to take longer-term money. Well, that meant that there was more credit discipline, market discipline on them. The banks couldn't use their federally insured deposits to speculate in the capital markets, and there was, a good regulatory regime over them. You then had what was a much more stable and segmented financial system. Banks were banks, securities firms were securities firms, insurance companies were different yet. Each sector was independent, and problems in one didn't immediately spill over into the other. So if a problem arose in one sector, regulators could deal with that without having to bail out the entire system. So of course we undid Glass-Steagall over about a 20-year period between the early 1980s and the late 1990s. It was chipped away at and then finally repealed. And less than 10 years after it was repealed, we ended up with the global financial crisis, which was caused by the same kind of activities that led to the Great Depression. You know, what happened in the global financial crisis was the Fed had to wrap its arms around the entire financial system. We had to bail out money market funds, which are essentially illegal deposits, in my opinion. We had to bail out the repo market, which in my view, again, is an illegal deposit-taking business outside the banking system. We had to rescue the big securities firms. Now this crisis, we've gone even one step further because, okay, we've essentially made clear that the banks are not going to fail. We bailed out the money market funds again, second time, you know, shame on us. First time, you could say shame on them. Second time, shame on us. We knew with the money market funds, they're illegal deposits. There's no deposit insurance. There's no capital requirements. They are prone to fail every time there's a crisis, and we allowed them to continue existing. We bailed out the repo market again. Shame on us. But this time, because we didn't change the system, and we allowed the system to keep taking more and more and more risk, now the risk migrated into the corporate loan market. So, you know, we've mentioned private equity. What has private equity been doing over the last decade? Private equity, in combination with banks and their capital markets activities, has been churning up huge amounts of debt, very high risk debt, taking much of that debt and paying it out in dividends and stock buybacks. I think I saw something the other day that, I think I'm right, the amount of dividends and stock buybacks over the last decade is something in the order of $4 to $5 trillion. I think I'm right. It may be more like $8 trillion. Much of it funded by debt. Okay, we allowed corporations to take on way too much debt. Of course, private equity funds and banks are greatly exposed to that debt. So what happened when the crisis happened? Now the Fed did it with what it's never done before. Now the Fed says, oh, we're going to back up the corporate debt market too. Even corporate debt that's no longer investment grade, we're going to back that up. So we keep expanding the federal safety net. This kind of gets back to what Commissioner Chopra was talking about in terms of government subsidies for people who are taking way too much risk and then expect to be bailed out when the risks go bad. So my view is Glass-Steagall would you know, a new Glass-Steagall Act, which is what I'm proposing, would put us back to where we were in the 1930s and 1940s and up to the 1980s. That banks couldn't take government money and speculate with it. The capital markets people couldn't essentially take what are, you know, make-believe bank deposits and then assume they'll be bailed out when the trouble comes. You wouldn't constantly see this endless cycle of speculation, more debt, more speculation, more debt, more risk. Of course, we're now in a situation where the Fed has also not only been able to bailing out these people, but they've also pushed interest rates down to about zero in order to allow more debt to be taken out to refinance the debt that already exists. What that means is if you put your money in a safe place, like a bank deposit, you'll get virtually nothing. What's happening to pensions? Pensions are way underfunded now because pensions cannot get any kind of decent return from a safe investment. You put your money in a T-bill fund, you're going to get less than 1% from government T-bills. So the Social Security system, to the extent that it's based on treasuries, also is getting no income. So we're now punishing safe investors. We are rewarding speculators, and increasingly the government's having to bail out the speculators. I think that has a lot to do with why the top 1%, and especially maybe the 1/10 or 1/5 of 1%, their wealth is going up, because they're putting their money in private equity funds, hedge funds, expensive real estate, and that's all being propped up. My view is if we want to have meaningful market discipline, stop government crony subsidies, what I call crony capitalism, you have to put something in place like Glass-Steagall. And you also, that would break up the banking system. So I think you'd have many more what I would call community relationship-based banks that would have a much greater reason to help their local communities, to help their local businesses, they would not be sending their money off to Wall Street. I think it would have a number of really positive effects. Just to put a little plug in, I have a book coming out next month. It's called Taming the Mega Banks: Why We Need a New Glass-Steagall Act. So if you want to learn more about why I think this is an approach we should take, I certainly invite you to pick up the book, and obviously I'd be delighted to hear any feedback on it from those who read it. Thank you.
Thanks, Art. Thanks, Art. Okay, going to Greg now. Much has been made by the financial industry and by the business lobby about how regulation kills jobs or hurts the bottom line of companies. And anyone that's done any kind of lobbying against those interests know that no matter what issue, that is always their refrain. But can you speak to how financial regulations can facilitate job creations or help build a kind of economy where more people thrive?
No, absolutely, Ryan. We've definitely have, up on the Hill, we've heard this several times, as you're well aware. So ideally, financial regulations would result in financial stability. And if the cost of complying with the new regulation is less than the cost of the financial crisis that would have occurred if you didn't have the new regulation, then the rules actually enhance, economic growth and hopefully ultimately net hiring. So ideally, that's how it would work. I agree with you that the regulations are frequently discussed, only in the context of threats to job creation, while their, role in protecting lives and public health and the environment is just unfortunately ignored in ultimate, hopefully, ideally, job growth. So, with weak or absent regulations can be a direct threat to the economy and employment. With inadequate regulations, financial markets can collapse, consumers lose faith, the industry products diminish, sales, regulatory failures can harm the economy, while strong regulation can facilitate markets functioning and often necessary to produce stable and flourishing job markets, which ultimately just means jobs. So ideally, that's the way we look at it at the AFL-CIO, that, financial regulation is not a bad thing. It's a positive thing that brings stability and ultimately creating a system that is thriving and jobs are hopefully and preferably abundant. I can't hear you. Unmute yourself, Ryan.
Yes, sorry about that. Okay, we'll turn to Rich. Especially in the light of the COVID-19 crisis, what are some of the threats to consumer financial security that policymakers, in your opinion, need to be addressing?
Sure, thank you, Ryan. So I think we're all, extremely worried about what lies ahead, given the scale of the crisis and how long it is likely to go on. So one area that we're particularly focused on is the housing market, and not wanting to, relive the foreclosure crisis that we went through a decade ago. And the impact of that crisis is still playing out. So, that drained enormous amounts of wealth, especially from communities of color. And, we're way set back still. So we really think it's important for policymakers to do everything they can to make it possible for people to stay in their homes, to provide for forbearances on mortgage payments, and to make it automatic and something that people don't have to ask for and go through red tape and hoops to have it happen. when those periods eventually end, to be required to have flexible loan modification options that are easy to administer. So another lesson that we learned from 10 years ago was just how difficult it was for people to get a loan modification, how the servicers were not staffed to handle it, and the system was a mess, and people were really just sent, had all kinds of trouble trying to get a workable loan modification. We documented that problem extensively. So we want to try to avoid that this time and try to get out in front of it and keep people in their homes, because the impact is considerable for the individual, the family, and the community, across the board. So related to that, we're also very focused on the credit reporting system, and don't want people to suffer in their credit report from what they're going through right now through no fault of their own because of this crisis. So we think it's really important that there's not negative reporting based on someone's inability to pay something because of COVID. So there should be a moratorium on all negative content related to any mispayment during the crisis. And so that just leads into the broader reform of the credit reporting industry that we have been working on for a very long time, and with Chair Waters leading the way, we're really hopeful that that will become a reality in the future. But as it relates to COVID-19, at least, people should not have any negative consequences in their credit reports because of what's going on right now. That would be tremendously unfair if that were the case. So those are just a couple of things that we're looking at, but there are many, many other things that we're working on every day to try to protect consumers as it relates to COVID-19.
Thanks, Rich. Okay, our final question is for you, Art. And you spoke a little bit about it before, but we're experiencing now like our third major financial shock in this country, the first being the Great Depression, the second being 2008. And as you noted, we took very different approaches to the Great Depression and now, and given that history of somewhat of the lag time before FDR and the New Deal to deal with it, we're seeing a little bit of a kind of lag time between the hit of this crisis and probably, until we probably get a new administration and a new Congress that is more willing to deal with the crisis in the terms that, at the level that the crisis requires. But can you speak a little bit more about the differences between the Great Depression relief program and recovery program versus 2008, and what lessons we should learn from those for this response to this crisis?
Certainly it's interesting that, that in addition to the Glass-Steagall, which I think was, to me, the cornerstone of the financial reform of the 1930s, you also had things like the Homeowners Loan Corporation, which bought up the mortgages to over 1 million homes and allowed the owners to stay in their homes and under restructured, lengthened mortgages and not lose their homes. Before the Great Depression, most mortgages, almost all of them, didn't have terms longer than 5 years. And so at the end of 5 years, you had to refinance the mortgage or you were out. And of course, during the Great Depression, it was impossible to refinance mortgages. So basically, people were losing their homes at alarming rates until the Homeowners Loan Corporation was created, which was the first time that that we began to have long-term mortgages. And then they created something called the Federal National Mortgage Association in 1938, I believe, which was sort of again, the cornerstone for the 30-year mortgage. So, you know, that accomplishment is worth remembering because it gave American homeowners the ability to have long-term mortgages with, you know, predictable payments that they would not be at risk of losing when sudden, you know, economic storms came along. And I think that, you know, what Rich has said is certainly absolutely true. If you look at what happened after the global financial crisis, I think one of the, in my view, really lamentable parts of that crisis was that we didn't do much at all to help people stay in their homes. I mean, even there were very few modifications that allowed people to reduce the principal amount due. They might allow you to postpone some interest, but most of them, you know, might postpone interest for only a few years, and then suddenly there was a sudden step up in interest that you had to pay or lose your home, and they didn't in any way help people who were underwater. You know, they're again, through no fault of their own, the home market had collapsed and they were underwater, and there was no way that they could, you know, get out of the mortgage if they couldn't pay it. They couldn't sell the house, they couldn't pay the mortgage, and so they had to go into foreclosure. And the foreclosure mitigation programs were very minimal. Now, there's an interesting twist to this story. Why were they so unwilling to do principal modification? Why were they so unwilling to help underwater homeowners? Well, it turns out that the big four banks held about $500 billion of second lien mortgages on their balance sheets in the middle of this crisis. Those second lien loans had mostly been created in conjunction with subprime first liens that then were securitized, but they couldn't securitize second liens. They held them on the balance sheet. And basically, in my view, the decision was made, we can't write down these second liens without jeopardizing the big banks and bailing them out over again. So we're not going to make them write them down. They didn't make these banks write down these second liens for several years. And in the meantime, people went belly up and lost their homes. So I think, you know, that story tells me that where do we put our focus? Do we put our focus on a stable economy? I mean, Greg has made a good point about you need regulation for a stable economy so you don't have booms and busts all the time. Do you put your focus on homeowners, citizens, or do you put it on propping up the big banks at all costs, right? And my view is, why are we being held hostage to these institutions? I believe that our financial policies are essentially held hostage to the giant universal banks and the giant shadow banks. They basically get what they want. They get their way. When they get into trouble, they're bailed out. I think we have to ask ourselves, why would we allow that system to continue? It doesn't make any sense. So my response, I guess, is a bit of a challenge. If we don't want this same cycle to keep going on and on and on, I think we have to change the system so we aren't held hostage to these giant institutions, so that they don't basically feel that they can get away with whatever they want to get away with. You know, Commissioner Chopra said, isn't it interesting that not one single senior executive of any major bank was held criminally responsible for anything, and only a handful even were given civil sanctions. And the typical defense was, I didn't know what was going on, right? I just told my underlings what to do, and I didn't know what was going on. And a good friend of mine, you know, said one time, well, if they didn't know what was going on, isn't that the best argument for breaking these guys up? I mean, in other words, if these guys are so big, so complex, so tremendous that no CEO could possibly know what's going on down below him or her, why should we allow such institutions to exist? I mean, they're unaccountable, irresponsible. So I guess I'm sort of saying, I think we have a system that to me is unstable, unsustainable, and unacceptable. We need to find ways to make that system change, I think.
Thanks, Art. So Greg, Christina, Rich, do you all have any last thoughts before we go?
No, I just want to, again, reiterate my thanks to AFR for all the panelists and Congresswoman Waters and Hilary and everybody who continues to, enlighten everyone about the dire situation we're in. And I hate to seem so melodramatic, but I think that we were really going into a very similar situation as we were in 2007 and 2008. And I'm not an economist or expert, but I think if you connect the dots, it seems very much, a very similar situation. So, I just thank AFR for continuing to try to enlighten us on how we can make a difference.
Same. I want to say thank you. And I want to say that in every space I come into where we're talking about what kind of policy changes we might need or what systemic changes we might need, despite the fact that all of these systems are really hard to, untangle and to describe to everyday people, it is the everyday people who are going to have to suffer the worst consequences of bad systems. And so we are all really responsible for making sure that we are connecting to real people's experiences, helping them understand, what's at play, and helping or allowing them to help us decide not only what the policies are, but what are the sequence of policies so that their, immediate needs are taken care of. And we're not sort of, tinkering at levels that are technical that don't really impact people in the way that we need to when they're in such dire straits.
Yeah, I would agree with that exactly. I think we have to keep in mind who we're fighting for and what they believe, what they need. At NCLC, we do our work on behalf of our low-income clients, and it's really important to keep them at the forefront of this, because that's what this is all about. So thank you for having us.
Thank you, Ryan. Great to be part of this panel. Thanks for leading us so expertly. Thank you.
No problem. Well, I'd like to thank all the panelists and all our attendees in our audience. Special thank you to, of course, Chairwoman Waters for our keynote address, and to Commissioner Chopra for that interesting conversation. And so I just want to take a second to remind everyone that this is the third session in our series of events marking the 10th anniversary of Dodd-Frank, and thinking about what to do to build a just financial system. I think one thing this conversation has definitely really put a spotlight on, and I think Arthur mentioned it, that we had a very problematic financial system and economy for regular people before 2008. Dodd-Frank did a lot of good things to try and help, but it didn't change the underlying fundamentals of the economy, and the actors with resources, once it passed, have been chipping away at it relentlessly for the last 10 years. And so we are really in a place where we really have to redouble our efforts to protect consumers, investors, and workers, to make sure that we are building the economy that works for everyone. So the videos of the previous series events are up on the AFR YouTube channel. This was recorded and it will be put up there as well. Just look to AFR. We will be sending out we will have further events commemorating the 10th anniversary. So check our website for updates. And this concludes today's session. And at this point, we will end the broadcast. Thank you for joining us. Thanks, everyone.